Hey everyone. Navigating the trading space can often be like trying to find your way in a dense forest filled with scattered information and confusion. Achieving consistent income from the market requires a well-structured trading plan that cuts through the noise. In this video, we're excited to introduce a comprehensive smart money trading plan that will guide you step by step towards success. Let's start by talking about the main things that can make your trading better. The first thing to do is to look at the smart money ideas on the chart. This helps us understand the market better, like where it's going and what key levels are important. We'll figure out if the market is going up, down, or not really moving much. Next, we'll talk about the second step. This is when we look at the best places to trade and specific areas on the chart where we can make good trades. These areas are like hotspots for good opportunities. We'll also talk about the concept of liquidity, which helps us avoid unexpected losses. Finally, we'll look at how to start and manage a trade. This is the last important thing we'll focus on. We'll talk about how to actually make the trades based on certain details and how to change our plans if the market conditions shift. This part is crucial for making sure we stay successful in our trading. Now let's dive into the strategy. Our trading plan works with two main time frames. First, there's the higher time frame where we do most of our overall analysis. Here, we look at the big picture of the market, understanding its structure, direction, key levels, fair value gaps, and the crucial optimal trading zones that might give us great trading opportunities. Moving on. The second part takes us to the lower time frame. This is where we confirm our ideas and actually enter trades. It's important to note that while our plan isn't limited to any specific chart or time frames, your entry time frame should be 2 steps smaller than your general higher time frame. For example, if we're studying the market structure on a 4-hour chart and finding optimal trading zones, we'll then shift to a 15-minute chart for confirmations and entries. Similarly, if our higher time frame is the 1-hour chart, we'll zoom into a 5-minute chart to open positions. I've simplified this trading plan into 5 easy steps. Once we go through these steps, we'll take a closer look at entry models to visually explain how the strategy works. If any part seems a bit tricky, don't worry. We'll explore each step thoroughly with real chart examples, offering real proof of how well the strategy has performed in the past. Stay tuned. Let's kick off by tackling the first step, analyzing the market structure. In this general analysis, we're putting smart money concepts into action on the chart to simply figure out where the market is headed and identify key levels. Now, there are 3 types of markets when it comes to direction. First up, we've got a moving uptrend. This happens when the price keeps making higher highs and higher lows, breaking the structure to the upside. Trading with this dominant uptrend increases our chance of success. The uptrend continues until there's a change of character, a signal of a possible reversal. The second type is a moving downtrend, where the price consistently makes lower lows and lower highs, breaking the structure to the downside. We trade with this dominant downtrend until there's a change of character, switching the market sentiment to bullish. Lastly, we have a directionless market. This happens when supply and demand aren't strong enough to push prices in a clear direction. In this case, we continuously see changes of characters on the opposite side, and it's challenging to identify a clear trend. Our trading plan is all about trend continuation, so we use it when we can clearly identify the price direction. Let's take a real example on the pound-yen 4-hour chart to put this into action. Here, we observe a clear moving uptrend with higher highs and higher lows. As long as we stay above the lowest point of the correction, called the swing low, we consider the market bullish. The second key level is the latest high created by the price, which we use to set our higher time frame target. Now, the market breaks structure and creates a new high, but it barely pushes the price upwards, showing a loss of momentum. We then notice a break and close below the latest swing low, a valid change of character. Now, we're no longer in an uptrend, and we wait for 1, 2, and 3 moves to the downside to identify the direction as bearish. We mark the most recent key levels and look for short opportunities. Let's move on to the second step, where we'll dive into key concepts of smart money to identify fair value gaps, liquidity areas, and optimal trading zones on the higher time frame chart. Firstly, let's understand the fair value gap, which is a 3-candlestick pattern characterized by a significant gap between the shadows of the first and last candles with no overlap. These gaps occur due to an imbalance between buyers and sellers, leading to sharp moves. The market often revisits these gaps to fill remaining orders and restore balance. If there's enough liquidity, the market will continue in the same dominant direction. Liquidity is the fuel of the market, and liquidity areas are where retail traders enter the market and place their stops. We focus on equal highs and lows and the latest swings for simplicity. If the market grabs these liquidity areas, the chances of success significantly improve. Optimal trading zones are areas where high-quality trading concepts converge, including valid order blocks and order flow areas meeting specific rules. These become excellent levels to look for trading opportunities. Now let's apply these concepts to real chart examples. Taking the Euro-Dollar 4-hour chart as an example, we observe a moving downtrend with considerable fair value gaps recently created. If the price returns to fill these gaps before continuing its general direction, it presents a perfect trading opportunity. Identifying the liquidity area, we note that a previous swing low level, once broken, turns from support to resistance. This becomes a potential rejection point. Traditional price action traders would see this as a short opportunity, placing their stop above the zone, where significant liquidity gathers, providing an opportunity for larger players to grab the liquidity they need, leading to a price drop after triggering the stops. Now, let's delve into the third step, focusing on confirmations and entry points. In this stage, we apply market structure concepts, patiently waiting for entry signals that align with the higher time frame analysis. After the fair value gaps area has been addressed, we actively seek reversal signals to validate the entry. This involves waiting for a change of character to confirm that the short-term trend has concluded, signaling the market's potential to continue in line with the dominant higher time frame direction. If there's no change of character, we abstain from making any trades. Upon confirmation of a change of character, two entry trading models come into play. Bullish scenario. If the change of character move creates a valid order block with fair value gaps, we set a buy limit order a spread size above the order block and a stop below the swing low. To secure our trade, we make it break even by closing half of our position when the price reaches our 1 to 2 target. Subsequently, we close our profits fully once the price reaches our higher time frame supply area. Second trading setup. In cases where there's no fair value gap or order block, we utilize the Fibonacci retracement tool from the start to the end of the change of character move. Placing our buy limit precisely at the midpoint of the 61.8% and 78.6% Fibonacci levels, our stop is positioned below the swing low. Similar to the first setup, we apply the same principles for taking profits. By following these entry models, we ensure a systematic approach to opening positions that align with the overall strategy. This strategic method enhances the likelihood of successful trades and helps manage risk effectively. Before applying this strategy with real money, conduct thorough backtesting on historical data. Backtesting is essential to evaluate the performance, build confidence, and prepare for potential risks associated with trading. Remember, adhering to these guidelines and conducting comprehensive backtesting will enhance your understanding of the strategy's historical performance and help you make informed decisions when implementing it with real capital. That concludes this video. And if you found it helpful, don't forget to hit the like button and subscribe for more content. Additionally, I want to inform you that our Forex Signal Telegram group chat is now live and operational. Click on the link provided in our channel description to join us and stay connected. Your participation is highly valued, and we look forward to having you as part of our trading community. Thanks for watching.